Good evening, unit holders, ESR-REIT, ladies and gentlemen, stakeholders. Welcome to the SIAS ESR-REIT virtual dialogue session. Today we have with us Adrian Chui, the CEO of ESR-REIT, and we have Ms. Karen Lee, the CEO of ALOC, for today's virtual dialogue session. And without much ado, let me bring on to you Adrian Chui for his presentation on the merger with ALOC. Adrian?
Thanks, Wanchan. Thanks a lot. Good evening, everyone. Thank you for taking the time to attend the dialogue session. This is a merger of two best-in-class REITs to form ESR-Logos REIT. When we first announced the merger on 15 October, the rationale was very clear. In the REIT space, size increasingly matters. And this merger will solidify the enlarged REIT's position amongst the top 10 largest S-REIT based on a free float market capitalization. The implied offer price payable to ALOC unit holders will be satisfied by 90% stock and 10% cash combo. To illustrate, ESR-REIT will pay 95 in cash for every one ALOC units held, and the rest through the issuance of 1.6765 new ESR-REIT units. The issue price of ESR-REIT will be 51 cents, which implies a gross exchange ratio of 1.863 times. This proposed merger is conditional upon the completion of the indirect acquisition of the manager by ALOC by ESR Group. Shareholders of ESR Group has approved the acquisitions of ARA Asset Management during the EGM held on the 3rd of November 2021. This transformational merger will create a leading new economy and future-ready APAC S-REIT with increased relevance to industrialists. Together, the merged entity will be renamed as ESR-Logos REIT, or ELOC in short. This is a strong and clear message that this will be a combination of two best-in-class portfolios and management teams. ESR-Logos REIT will continue to be sponsored by ESR Group, the largest APAC real asset manager and a leader in new economy sector of logistics and high-specs industrial space. This will accelerate our pivot to the new economy sector towards resilient businesses such as logistics, advanced manufacturing, and data center operators that have grown tremendously despite the challenges provided by COVID-19. The enlarged REIT's total assets of 5.4 billion will be more diversified and resilient with access to wider pools of capital at more competitive costs. Once the merger completes, ELOC will comprise 87 properties in Singapore and Australia, and 41 fund properties in Australia with a total asset size of 5.4 billion. It will continue to be managed by ESR-REIT manager with the best-in-class talent from both REITs. ESR Cayman and the Summit Group will each hold about 11% and 12.7% respectively. I will now expand on the key benefits of the merger. There has been a paradigm shift in the way goods are consumed, produced, and delivered. Driven by the increasing demand for modern logistics from multiple sectors such as last mile, cold chain, etc., and high-value advanced manufacturers, there is a sustainable demand for logistics and high-specs industrial space. Due to supply chain disruptions, we are now seeing manufacturers storing raw materials in warehouses for production. What has traditionally been just-in-time manufacturing has increasingly become just-in-case. As we all know, the logistics sector has experienced significant growth, accelerated by changes in the global supply chain and the ongoing pandemic. ELOC will benefit from an increased exposure to in-demand new economy assets such as logistics and warehousing properties, as well as cold storage facilities. With the addition of 20 properties in Australia and stakes in 2 Australian logistics-focused funds, ELOC's portfolio will gain exposure to key logistics hubs located in gateway cities and a highly desirable and stable network of tenants. The merger will mitigate portfolio risk significantly with increased diversification in terms of geography, income, and land lease tenure. The merger will also increase our exposure to freehold properties to boost portfolio resilience. Next, a larger portfolio would also significantly reduce tenant concentration risk. contribution from our top 10 tenants will reduce from 29.4% to 26.3% by gross rental income. At present, we have 360 tenants. Post-merger, we will have about 437 tenants with diversified trade mix, and the top 10 tenants will account for less than a quarter of a gross rental income. In addition, no single tenant will account for more than 4.6% of the enlarged REIT's gross rental income. Besides improving on economies of scale, an enhanced size and scale would also bring about opportunities for operational synergies and portfolio optimization, where there can be further potential cost savings for tenants and stronger bargaining power with service providers as well as our tenants. These potential synergies have not been built into the pro forma accretion DPU financials. While we believe there are potential upside, we will need time to work out the scale and the breadth of the synergies and how much economies of scale that we can extract. For example, while we can amalgamate our cleaning contracts to have better bargaining power, we need to wait for such existing contracts to expire. ELOC will have a larger free float market cap, both in terms of total dollar value as well as percentage-wise, and we expect ELOC to enjoy greater representation on the FTSE EPRA Nareit Global Developed Index and other major indices. This puts us on the radar screen of many long-only funds as well as index funds, which are expected to drive potential positive re-rating for the REIT. Importantly, we expect to further improve our debt competitiveness. We have already seen the immediate impact of this merger with lower costs, longer debt tenure, as well as 100% unencumbered assets. This sets us up nicely to access wider pools of capital at more competitive costs as we grow our portfolio. As mentioned earlier, ESR-Logos REIT's position will be solidified amongst the top 10 largest S-REIT based on a free float market cap of $2.5 billion and backed by a strong sponsor with an integrated business model across ownership, development, operations, as well as investment management of new economy assets. ELOC will also leverage the sponsor's global tenant network, especially with leading e-commerce, 3PL, advanced manufacturing tenants, and data center operators to operate and grow organically. The sponsor's strategic symbiotic relationship with these tenants provide insights into tenants' expansion strategy, thus providing a first-mover advantage to grow and fill up our tenant base with blue-chip names. With the support of our sponsor, ELOC is able to leverage the group's operating platform, financial strength, footprint, and network to accelerate our growth trajectory. With the robust demand for new economy assets, ESR Group has accelerated the rollout of its new economy strategy. The meaningful presence that ESR Group has assembled across 10 markets in APAC, which the enlarged ELOC can actually leverage on, for on-the-ground presence, de-risk entry into new markets, as well as access to tenant networks. ELOC will have access to more than $50 billion of assets in an increasingly scarce environment for quality properties. For example, with approximately $2 billion of visible and executable asset pipeline, both from the group and externally, in the short term that we can look to acquire as we look to supercharge ELOC's growth into the leading future-ready APAC REIT. ESR Group, on completion of the acquisition of ARA Asset Management, will be the #1 real estate and real asset manager. The group will have the largest new economy AUM in Asia-Pacific, with about 1.8 times work-in-progress development deals, which is larger than their closest peers in APAC, resulting in ESR Group becoming the largest S-REIT sponsor by AUM in APAC. ELOC is poised to benefit from the support of our sponsor to supercharge our growth. With a larger vehicle, we are also able to realize growth opportunities with a larger development headroom. ELOC will have greater capacity and flexibility to undertake developments and asset enhancements to develop unutilized gross floor area at a lower cost of capital as well as lower leasing risk. With an enlarged asset base, our DPU is also less likely to be negatively affected when we undertake AEIs at all redevelopments when our buildings are closed off. The merger is expected to be value accretive to our unit holders on a historical pro forma basis. As you can see on this slide, the merger will be 5.8% DPU accretive to all of you. One of the recent hot button topic is ESG, which has become increasingly important in our operating DNA. We have implemented various green initiatives and ESG efforts, such as solar harvesting programs to reduce carbon emissions. ALOC has launched a bespoke 80 million green IRS that is tied to green targets. Both REITs also made their inaugural GRESB submission for FY 2020, thereby enhancing our ESG disclosures. The ESR Group has accelerated our ESG initiatives across its portfolio assets, building on established success to lead ESG transformation in APAC. Similarly, ELOC will have reinforced commitments to ESG performance and continue to undertake green initiatives. ELOC will provide appropriate disclosures and commitments to achieving our green initiatives and have strong governance and embrace diversity in our workforce. As ESG issues have come to fore with investors, we believe that together with the support of the ESR Group, we have made great strides in this area. We will be able to provide more robust ESG offerings. In conclusion, this merger is transformational and accelerates the pivot of ELOC to new economic sectors that are set to dominate and deliver sustainable growth going forward. A larger, more diversified and resilient ELOC will have a clear growth trajectory given our unrivaled access to new economy asset pipeline and ability to access wider and larger pools of capital at lower costs. We are able to do more and faster. The merger is DPU accretive to all unit holders on a pro forma basis. Whether from an organic growth, acquisition, and or capital management perspective, we expect ELOC to continue to deliver and create value for our unit holders. Thank you.
Thank you very much for that, Eden. Great presentation. Let me start the Q&A session quite quickly because we only have about 45 minutes left to the session.
Sure.
Let me start by how you started, Adrian, when you talk about size does matter.
Yes.
So with the merger, the merged entity will be in the top 10 S-REIT in Singapore,
Yes.
but there'll be other bigger than you.
Yes.
So
Sure.
how do investors choose who is bigger, who is better?
Yeah, I think that's a very good question, Wan Chen. You know, the demand for new economy assets has only just begun, and this has brought about primarily by COVID-19, as well as technological advances in manufacturing over the last 2 years. This paradigm shift, as I mentioned earlier, has changed the way we produce goods, deliver goods, as well as consume goods, and it has only just begun. I think more importantly, as I highlighted just now, the enlarged ELOC is actually very well positioned to tap into our sponsors' $50 billion pipeline, and on top of that, there's another $10 billion of development pipeline in progress. You know, this and I also highlighted earlier in the slides that immediately we are looking at about $2 billion of assets that fits our investment criteria we can acquire, immediately. And these assets are really highly sought after assets as we speak here. You know, so the potential for the growth for ELOC is actually very, very high after the merger. Now, due to this early stage of growth, we are of the opinion that there is still ample room for more established, so-called larger and established REITs. You know, yes, there are a couple today, but we believe that with our pipelines and all, we are actually in a position to eventually be a large and established REIT as well, and there are ample room for this. And one of the factors, importantly, that unit holders or shareholders and investors could look at is that when we think about the relative size of ELOC versus some of the larger and more established so-called new economy REITs, we are of the view that if there is a $1 billion portfolio that is available for acquisition, the impact on the DPU growth for ELOC will actually be more profound and more meaningful as compared to a larger one. It's basically on a relatively sized basis. And also, in a way, we also think that if you look at the valuation parameters or investment parameters of price to book ratio as well as yield differential, I do think that we still offer certain values to investors for investing in us.
So one more question before we go to Karen, Adrian.
Yes.
So size does matter, but by being bigger than you doesn't necessarily make it better because of the profound impact that you just mentioned.
Yes, exactly.
So one of the questions from the floor is how do you then get to the next step? How do you keep on growing, Adrian?
So I think the key important part is we have pipelines.
Okay. 2 billion to start with.
2 billion to start with, and total $50 billion.
That's a big chunk.
Yeah. But as for all investors, we want it, but we also need to see how much the market can stomach it.
So there's size and there's upside.
Yes, exactly. So we know where we are in a sector whereby the tailwind is behind us, the whole industrial sector, the whole paradigm shift in how things are produced, consumed and all. So it's very exciting times for us. The ingredients and the tools are there. What we need now is a larger platform so that we can grow faster and larger.
That's good, Adrian. Karen, what's your take on size?
I echo what Adrian has just said, but I think to look at the growth strategy of the REIT, we also need to look at the strength of the sponsor. So other than the strong pipeline that our sponsor is going to offer us, we are also relying on the sponsor's global network and diversified tenant network across the various regional markets. And it actually allows us to start looking at some of these markets where our sponsor has presence in. And when they have local presence, it helps us de-risk any new market entry. And beyond just providing the pipeline, our sponsors have also demonstrated that they will commit to support us in capital funding. And with a strong sponsor providing us capital funding support, it will increase the success of any acquisitions tremendously. So with a clear growth strategy as what Adrian has articulated, a strong sponsor with a strong track record, we are very confident that we will be able to deliver the sustainable long-term growth for our unit holders.
Thanks, Karen. So it's really size does matter, but what also matters is really the ability to keep on growing.
And pipeline is where pipeline and the sponsor that Karen mentioned actually comes in. One of the key factors that I also want to add is that increasingly, as we have customers and clients like to have this network effect, and these large customers, they operate internationally. They know more. They don't really operate just a local market. They have Asia Pacific footprint, global footprint, and because they want to expand their network, which is important for their own businesses, they want to partner real estate companies that has that global or pan-Asia footprint. And this is where the sponsor comes in. Customers are the most important ingredient in driving DPU. Without the customers, your buildings is empty, you can't get the DPU, right? So to us, customers is important, and with the sponsors' network, scale, footprint in all these areas, we are then able to support not only existing customers as they expand, but actually new customers. So, and this further drives the DPU, and when it drives the DPU, it drives, and then coupled with our competitive cost of capital being an enlarged REIT, we are then able to then expand more to have more assets, and when you have more assets, there will be more customers willing to take your space because they want to create that network effect.
Okay, Adrian. Next question on diversification and concentration. But before we go there, there's a side question about the $2 billion pipeline.
Okay.
So that's quite immediate.
Yes.
What's your sentiments about that? With that headroom, what's the likelihood of that happening?
Oh, no, I think it always crosses our investment criteria. I mean, we look at the pipeline of $2 billion. It fits our investment criteria. It fits our investment mandate. It fits where we are to have that. The important part is, as always, is how much can the market absorb, and how much then will it change the overall portfolio. You want to make sure that whenever you acquire something, you can digest, and we think that this $2 billion portfolio is something that we can take it because with an enlarged 5.4 billion platform, we are much bigger. We have the ability to issue more equity. We are able to get more competitive cost of debt to fund it. Yeah.
So the merger is DPU accretive straight away.
Correct.
$2 billion pipeline. So not just size, but growth.
Exactly.
Almost
the growth,
immediately
the growth,
at the same
yes,
time.
Exactly.
That's
We
excellent.
do have that. Yes.
So let's talk about quality of the REIT now, Adrian and Karen. So there's a balance, or there's a need to balance between diversification and concentration. So with the merger, there's a concentration in logistics assets, but yet at the same time, you need to diversify. How do you plan to balance that post-merger, Adrian?
Well, ELOC, post the merger, we are very focused on the APAC logistics space because it's an in-demand asset class. And we believe that this demand is sustainable given that what I mentioned, the paradigm shift in how we consume goods, produce goods and all, as well as increasing e-commerce penetration. Importantly, as I mentioned just now earlier, customers are increasingly looking to create an efficient network for their businesses. And working with a credible landlord that has a good and established presence across various geographies is very important for them. So while geography as well as the subsector diversification have the benefit of immediately lowering the overall portfolio risk, there are other strategic benefits that we think they'll come across with diversification across geography as subsectors, which, like for example, as I mentioned earlier, scale and real estate presence, which is increasingly important for our customers, and customer is king because they are the one that drives our DPU. And this will allow us then to have the ability to get more, help our existing tenants expand, as well as get new tenants. The diversification geographically, as well as across particular geographically, is important because it helps to address the inherent short land lease tenants that is in Singapore industrial assets, as well as quite a tight regulation with regards to operating Singapore industrial landscape. The regulations are pretty tight, which actually to a certain extent hampers the growth, push down the growth profile. But nevertheless, Singapore is still attractive is because rule of law, you have the rule of law, money can flow in and out, it's an open economy. So by doing so we can get the best of the pros of having an industrial, but at the same time, diversifying outside geographically, it allows us to address the underlying issues of a short land lease. So that is why we see overall diversification into other countries, as well as trying to focus on logistics, which is an in-demand asset class. There's no conflicts over here. Yeah.
And what's your view, Karen? You bring to the table logistics assets, and you're going to merge with a diversified portfolio in ESR-REIT. So how do you balance that, Karen?
Yeah. Maybe a quick point on the why we need to diversify. Diversification actually helps to de-risk any potential negative impact to the market that one operates in, right? So, but on the flip side, it also helps us to enjoy any potential upside in the market that we will operate in. So diversification surely has some benefits. And looking back at ALOC operating across Singapore and Australia, from our past 12 to 18 months performance, we can say that our performance has been quite stable and good. So from the enlarged REIT's perspective, we have more opportunities to divest across even more countries such as China and Japan. And diversification will certainly bring about potential upside for the enlarged REIT moving forward. So that's more on geographical diversification. On asset class diversifications, for us, we are pure play logistics. And whereas for ESR-REIT, there are some high specs and logistics.
We are already
assets.
diversified in this
Yeah,
area.
so they are already more diversified than
Yeah.
ALOC. Yeah, but looking at how the economy is going to recover post-pandemic, we think that it is timely to diversify into such new economy assets such as high specs, data center, to give our unit holders the opportunity to tap on this growth market moving forward and not just focus on a specific asset class. So there's benefit for both sets of unit holders.
Yeah, Adrian, you want to chime in?
Yeah, maybe if I add, Karen and I, together with our sponsors, we operate regionally, logistics, customers from high-specs manufacturing sector, data center operators. What we have is that we are always in the market. We are talking to our customers. We managing our assets. So we have the data points to see which are the new sectors that's coming in, which are the sectors or tenants that is more on the sunset industry, which are the tenants, the new so-called new kind of tech companies that is coming in that needs certain kind of space, certain kind of specification for their operations. Because of this wealth of data information, we are then able to sit down and say, okay, this is the trend is coming. Is our assets relevant? And should we be positioning our assets to capture the increasing up and coming new sector? Or should we start to reduce our exposure to the so-called, what we like to call sunset industries that is probably not going to work? This sort of information is useful for us. And the point I'm coming from is with this kind of information, that we are able to establish the strategy and be able to position our whole portfolio and assets to be relevant. When your assets are relevant, then you are then able to drive DPU growth and able to add on to diversification. We don't try to diversify for the sake of diversifying. That's why I want to add to Karen's point. We know the pandemic is coming, but the pandemic, hopefully after 2 years, we are seeing that there's some lights at the end of the tunnel, and we must get ourselves ready such that our assets are ready to capture the new flows as well as all the new demands that's coming in.
So Adrian, Karen, the dots are beginning to join up.
Yes.
So with size, you can determine quality through diversification and concentration,
Correct.
geographically and otherwise.
Yes.
And through quality, you can drive size.
Yes.
Can we see whether there's a sneak peek into the $2 billion pipeline? What kind of quality assets do you have? Are you able to share with us that, Adrian?
Well, we, as I said, most of the assets that we have will be in the footprint countries where our sponsors are. And if you look at the portfolio of both ALOC as well as ESR-REIT, even for the kind of sectors like logistics assets, we have modern ramp-up logistics assets. So these are the kind of quality of assets you're looking at, because these are more the kind of assets that are more in demand by shareholders. And those assets that we believe that are still able to redevelop into modern ramp-up assets and all, we will continue to do that. Yeah. But I would say that in short, you will see that our acquisitions pipeline going forward will definitely be in the footprint countries of where our sponsor is. It's very simple. Real estate is a local game. You need your guys on the ground, not just a rep office, but a full-fledged platform, a full-fledged operating platform for property management, leasing, marketing to be there. And this is where the footprint of our sponsors group actually comes in.
Okay,
Yeah.
Thanks, Adrian. Let's now go into a bigger picture perspective, Adrian and Karen. What are the goodies that unit holders can possibly see with the merged entity? What are the upside besides DPU accretive?
In terms of the growth profile you're referring to?
In terms of higher yield, unit price, cost savings?
Yeah, I think if you look at where we are in the DPU of 5.8% that we say for ESR-REIT, these are primarily from two sources. Refinancing costs, lower refinancing costs, not because of increase in gearing. The gearing is marginal.
You already locked in. Already.
We locked that in. But it's the cost savings that is low. We are getting a close to $1.2 billion worth of new debt to refinance, as well as fund the 10% cash compensation, as well as pay upfront land premium at a much lower cost of 2.25% for 4.5 years.
That's good.
That's great, right? So, and the other half of the 50% of the reasons for why that contributes to the 5.8% DPU accretion is actually the upfront cost savings that we have when we acquire the ALOX Singapore properties. Now, we have not set down on synergies, cost synergies. We have not built that into the 5.8%. When comes size, there's always come synergies and there's come bargaining power. But Karen and I need to sit down after the merger is completed and then say, okay, right, both of us, this is now our assets. What are the synergies that we can do? And you can't do that immediately. And we have to sit down and look at it. It's because there are contracts that are in place. We cannot just tomorrow just cut off all the cleaning contracts and then call for a tender to ask for lower. It doesn't happen that way. So you will see that the cost synergies will start to flow in. And from our experience, because we did the merger with Viva 3 years ago, we always start to see the cost synergies comes in 6 months after the merger. Because this is where your contracts start to expire, you can now see which are the assets that can be managed more cheaply and all. Yeah. So I think the upside that you can see is obviously from acquisitions, DPU acquisitions, because we will be able to access lower funding costs, wider pools of capital that will allow us to do DPU or value accretive acquisitions. And on top of that, I think we can expect to be augmented by organic growth, contributing to the DPU from cost savings as well as synergies. Yeah.
So size, growth, quality, lots of goodies.
Yes.
Karen?
Maybe I can add on to Adrian's point. Other than the various goodies that Adrian has just mentioned, I think all this will be underpinned by a good quality portfolio plus tenants. So as what we have earlier on articulated about our sponsor is offering us a very good quality portfolio and also comes in with leading capabilities such as asset management, development. And the sponsor has very experience in constructing very good quality assets across the global tenant network for key customers. So I believe that the enlarged REIT will be able to cater to more of such quality tenants. And once we are able to provide sort of a one-stop, end-to-end real estate solution for our tenants, this will certainly provide or promote tenant stickiness. And with that, I think the portfolio metrics will be further strengthened. And this is all what we are after. We want to make sure that REIT portfolio is stable and has the embedded organic growth that we can tap into with with quality tenants.
Lots of Chinese New Year goodies, Karen.
Yes.
But with Chinese New Year, there's always this big bang of firecrackers, very exciting merger, ELOC, merged entity. What can go wrong, Adrian?
What can go wrong? Well, I think one thing is in the market right now is that the hawkish stance from the Fed.
Interest rates.
Interest rates. We have also seen historically whereby when what they like to call the taper tantrum 5-6 years ago, I can't remember the time, where there was an overreaction on the market. I think we learned that lessons, and that is the reason why, if you look at our capital management, we ensure that our loans are unsecured. We go for longer tenor, and we try to match our loan tenor with hedging tenor. If you look at the ESR-REIT hedging profile, we are always hedged close to about at least 2 years and above. Going forward with the enlarged ELOC, we don't see that changing. That should help to mitigate that. But obviously, if the whole interest rate environment goes haywire, interest rate blows up by 5 to 10 times, yeah, then definitely it will affect the overall cost of capital, cost of funding of the REIT, and it may then impact the pace of the acquisition growth.
But it still grows.
It will still grow. So it becomes the pace.
Well, with 50 billion in the pipe, 2 billion immediate.
Yeah, I mean, there's always market cycle. It's a long-term play. Markets, there's always cycles. Interest rates, there are always cycles. But our job is to ensure that if we see something that's coming, make sure your existing portfolio is hedged well, is hedged against this risk, we think that the most significant risk that's coming forward is actually rising interest. We are already seeing rising interest rates, don't get us wrong. The way that we want to do our AEIs, we have seen it, cost has just gone up. Construction costs, not helped by COVID. So when we see such risk, we got to ensure that we got to fortify our portfolio. We have done that in the end. And if some shareholders ask us, so Adrian, with a hawkish stance on the Fed coming up and people rising interest rates, is your $1.2 billion loan locked in or not? I tell you, it's locked in.
4.5 years.
Yes, right? There's no chance that the guys were going to change interest rate. No, we made sure that when we announced on the 15th of October, those are locked in.
At 2.5%.
2.5%. Yes, so
4.5 years.
Yes.
Wow. Okay.
Yes.
And Karen, from your point of view, what can go wrong in the year of tiger? It's a wet tiger, it's a water tiger. So what can go wrong, Karen? And what do you think should be your drawer plans?
I think likewise, from ALOC's perspective, interest rate hike is a potential risk that not just ALOC, I think everybody is facing that.
Yep.
But I guess to mitigate that risk, we just got to be very disciplined in our capital management strategy and do enough hedging.
Yeah.
That's more on the capital market side. But as we are moving out from the pandemic phase and hopefully the economy recover and the wet tiger bring us good news, we just hope that things will turn very positive, and if there's any other negative impact of the pandemic, I believe investors may pull back on their investments, or even tenants may pull back on their business expansion plans. But these are really beyond our control. But looking at how things are pan out across the region, I think we are quite confident that we should be able to recover from this pandemic phase.
Okay, thanks, Karen. Yeah. Let's go a bit more micro now and focus on the details. Share price, profitability, distribution. Any thoughts, any comments on this? Because this is where the bread and butter is, Adrian and Karen.
Yeah. I think our portfolio overall is large, very diversified. We're talking about 430 odd tenants. We are in a sector whereby it's sort of, to a certain extent, fortified from the COVID-19. Or in fact, we think that it is because of COVID-19, we have also been in a sector whereby it's enjoying unprecedented demands for space, via logistics, advanced manufacturing. We see that our DPU is stable. We have clear plans in terms of organic, from a acquisition growth point of view, to drive the DPU. We have shown we have gotten lower cost of debt to refinance. And we have a sponsor that is always supporting us, whether from assets or from capital growth. And if you look at ESR-REIT, we have done, in the last 5 years since the ESR came as part of the sponsor, we have done 2 fundraisings. And every time the sponsor backstops what we call the rights issue or preferential offering. This tells you the confidence that they have in these assets and how they can contribute. So I echo what Karen mentioned. Sponsor is important. Our sponsor is not just providing the assets, but they are also providing this financial support. And increasingly important, you will see that the sponsor will have to provide on-the-ground operational experience to ensure that the rentals are collected, the tenants renew their contracts, getting the new tenants in, so that the overall DPU can, if not stabilize, but definitely can grow.
So confident about DPU, confident about share price, confident about profitability.
Yes.
All strong numbers.
Yeah. We do have a clear plan of what we want, what we're to do. I think both REITs, even as of today, before 15 October was announced, we have our own track records and how we deliver our plans. It's no coincidence that both REITs are trading above NAV or trading above a price to book, from the sector-wise, from the sponsors' support and all. So, and we are now, that's what I mentioned very early, this is about 2 best-in-class REITs, both trading at above price to book, coming together. And this actually shows the market's confidence. And when we speak to our institutional investors the last few months, they understand the rationale, they know why, because actually majority of the institutional investors today, the big sovereign wealth funds, the big insurance company, the big pension funds, these fund managers are increasingly allocating money, more and more money, to less and less companies. And they want these companies to be big.
Size.
You would see that today, the most active guys who buy physical real estates are all these pension funds and all. They are essentially allocating larger pools of money to fewer and fewer fund managers that actually has large sizes of portfolio. And that is why it's no coincidence that you see the larger REITs, whether in Singapore or regionally, when they want to do fundraising, they are able to do it pretty fast. Because as it just points to the fact that this is the reason, because the big funds are all flowing to the smaller and smaller fund managers that are managing large portfolio. That's what we are seeing on the capital flows and from the market side.
And where do you think the capital flow is coming to in the region? Which country? China, Vietnam, Indonesia?
I would say all of this. But what we have seen is money has definitely flown into the industrial logistics sector. That's what we have been seeing. If not all the fundraisings that we do, we probably wouldn't have been able to do it. I mean, I did the recent fundraising. I recall to be in May. Equity fundraising. We are like 2.5 times oversubscribed. We raised around 150 million, and we came out having overall demand of over $400 million. And even for bonds, when I issued my bonds in August last year, it was like I only issued 125. The demand was like $400 million. I could price at like 2.6%. I mean, before when I first took over ESR-REIT, or then the old Cambridge Industrial Trust, a 5-year bond of $100 million cost me 3.5%. I issued August last year after the merger with Viva and growing to 3.3. I issued at 2.6% for 125 million with a demand that is close to $400 million.
From 3.5 down.
3.5, not only down to 2.6, but at the same time larger, 125. But the real demand was $400 million.
Oversubscribed.
Yeah, oversubscribed. So I think this is where we see the overall flows of as to answer your question, where the flows are coming in. They're coming into this sector and they are coming to Asia Pac.
If you to pick a country, both Karen and Adrian, which country will you bet on?
Oh, you want to bet?
Just pick one.
I don't think we will bet on any particular country. I think it will be the countries of Japan, China, Australia, Singapore. And very clear, it's because we have established platforms, established real estate platform from our sponsors who is there.
That's track record.
Yeah, and track record. I mean, you can pick the highest growth market, any country. All the EIU will tell you, Economic Intelligence Unit, research publication will give you which is the highest GDP growth. But if you don't have the infrastructure there to manage and find the assets, I think it's quite difficult, challenging to actually monetize and increase the distribution for our unit holders. And we feel that the countries where our sponsors has presence in those are the countries that it is suitable for us to go in and make sure that we can monetize the returns, high returns. High returns is one thing. Also managing the risk is also another.
Yep.
Right, high risk, high return, right? So then with the local on the ground presence, we are much more able to manage the risk while making sure that the returns comes back to us. Yeah.
Now, Adrian, you talk about sustainability, ESG in your presentation, how important it is. Climate change, climate disruption. What are your thoughts on some of these long-term plans? What are your specific strategy when it comes to sustainability?
I think obviously everybody applies a lot to solar panels. We already have, and that is the reason why both REITs do our GRESB rating. Doing a GRESB rating is a big step to tell people our intention of that. Now, solar panels is just one. but it's the way that also we do our things, the way we engage our tenants. And some of the tenants that now come into our buildings requires us to have processes like how their so-called byproducts from the manufacturers are being disposed of, the normal recycling, what things can be recycled. And they want to know our process, how we use water, and when that's one of the process. The second part is how we're going to look at sustainability. Some of that is when we do asset enhancements, when we redevelop our properties, we will go for green marks.
How we factor it, building,
Correct.
not as a bolt-on.
Exactly. And nowadays, and going forward, even when it comes to financing, we are increasingly looking at green bonds, green loans, because this will make us have a target.
Now, it's cheaper.
It may not be cheaper. Don't get me wrong. It may not be cheaper, but it affects the way we run the business. And if we don't have that, the tenant may not want to come in.
The tenant's looking for quality.
Exactly. They're looking for the green initiatives because they themselves also have ESG targets to meet. So to say that a green loan, as conventional loan, it can be cheaper,
not necessary.
Not necessary. But the differential has come down has narrowed tremendously. And obviously with Singapore government pushing for all these incentives and all, it makes a lot of sense. So nowadays, I do think this has become more important. We put more on that. And this is where, and I will be the first to say that our colleagues in other countries, in the ESR group, like in Australia, do a better job than us. But there is a template and a reference to act on that we can actually import into our own REITs to make sure that ESG continues to be at the forefront of the whole group's operating DNA.
So ESR is ESG.
Yes. And ESG has environmental as one. Green is always one. But there are also other things like social, even diversity. Yep. Workforce diversity. If you look at our workforce, we have diversity in the board, in the management, and in senior positions. Our chairman or chairwoman is actually a lady. So I think overall we focus not just on the environmental, but we also focus on social as well as overall governance and diversity as well. Yeah. That's our whole mental of ESG.
What about your view, Karen? The Singapore Exchange recently issued guidance on climate change reporting, climate risks, and to mandate reporting. Do you think that will increase the cost of operations of property companies, REITs?
ESG used to be good to have. Now it's a must-have. I think
it's no longer a choice.
No longer a choice. Like what Adrian said, the tenants are now starting to demand, that the building incorporates some form of ESG as well. But incorporating ESG is not. It may not bring down overall operational costs, but you can attract quality tenants. Over the long term, I believe that operating costs it will pay off. But for a start, the capex that's going into greening a building may be quite substantial. So it's a very long journey to have a good return on any ESG initiatives. So moving forward, like what Adrian has said, we're also tapping on the sponsors' capability in implementing ESG initiatives in the assets especially. So we can supplement this as an offering to our tenants and promote that tenant stickiness as well.
Okay, you're absolutely right. It's not a choice.
I think increasingly we have to have it as part of a DNA, operating DNA. That's for sure. Yeah.
Okay, Adrian, there's a cheeky question.
Yes.
A cheeky question here. Will you be working hard for
Of
more
course.
acquisitions, for more things? Maybe I can frame this, Adrian and Karen. What will be your 100-day plan? If today the merger goes through, what will be your 100-day plan to make things happen? What would be your lion dance?
Well, that's a loaded question, and Kalim is trying to ask me what is my immediate future plans. I think it's a fair question like that. Immediately, obviously, is integration to make sure that our financial accountings, the way that we operate, is in sync. Now, we don't have a lot of difference on that. A REIT is a REIT. The way that Karen's operates, the way that I operate, it's about the same.
So it'll be seamless.
It will be quite seamless. That is the most important priority, because there is regulatory requirements to make sure that we are operating correctly and we can report our results in time. So I think I would say that is the most immediate on that. And then we had to start to sit down and say which are the assets that we can extract synergies. This is the one that I think this is a sort of a lower hanging fruit that we can have, and then start to implement this, and then subsequently look at the fundraising, acquisitions. The acquisitions are there. It's just when we want to do it, and all. So the question is not really whether we will work hard or I will work hard or not. The question is actually how much time we have. If a calendar year is 16 months instead of 12 months, I think we can grow even larger and more, but unfortunately we only have 12 months. Yeah. And also in a certain function, how much we think that our shareholders are willing to stomach in terms of the size of the acquisition, and it's also a function. I mean, we have 2 billion. We are there. We know we can get it, but we also need to engage our own shareholders to see themselves where do they think, how much appetite do they have. A REIT is always operating on the fact that you can't depend on debt funding 100% to fund everything, because there is always a cap. And if you fund everything by 100% debt, it will always be accretive, but that's not the way we look at deals. We look at deals on the make sure that on the WACC that includes equity. And you have to raise equity is because by design, a REIT does not retain earnings. Yep. So to buy something, you have to raise equity. So this is something that we have to work on. The first 100 days, we have our work cut out for us. But it's not something that we don't know. Both of us don't know. We know. I probably have a little bit of a more experience because I've done the Viva merger, but it's not rocket science. It's not rocket science. Learned people around us.
So safe pair of hands.
We are there. Yeah, we are. Yeah, safe pair of hands for that. Yeah.
Karen, what's your exciting 100-day plan?
I think likewise, our focus should be on the integration of both teams. And we need to start looking at integrating the two platforms and, like what Adrian said, extract that operational efficiencies. And we have been talking about size does matter, and we need to take advantage of being a larger REIT and extract that economies of scales from our operations. And we believe that with a larger platform, we can operate a little bit more efficiently through allocating sufficient resources to our assets that's distributed across Singapore especially. And from the operator's background, I'm quite confident that we can deliver that. And 100 days is actually not a very long time. So
we hope that you tell us 200 days, but you give 100 days. So, so we have to answer based
100 days, this is what we need to immediately sit down and discuss what to do. Yeah.
So to sum it, the merger is size. You get there. You're going to be the top 10 S-REIT in Singapore.
Yes.
You're going to have
That's
quality.
immediate.
Yes, immediate. Yes.
And DPU immediate, accretive.
Yeah.
And you're going to have the pipeline of $2 billion.
Yes.
That's immediate. Another 50 billion waiting the sideline.
Correct.
Big and reliable parent up there.
Correct. And importantly, access to wider pools of capital as well as lower cost of debt. I think, in conclusion, one if I share is that we believe we have the platform and the ingredients and the tools to grow our DPU, the experience, the sponsors' support, and all. What we need to grow faster and larger is the platform. And I think this merger exercise does provide us the platform. And with the merger exercise, it's actually DPU accretive to both sets of unit holders. And we are operating and this merger is about two companies with a track record trading at above book coming together. Yeah, that's where we are.
And Karen, how will you sum it up? How will you sum up the opportunity that we have here for unit holders?
I think Other than what Adrian has just summarized, maybe I would like to add that both ALOC and ESR-REIT have already entered the FTSE EPRA REIT index, and that's already a testament to how good both vehicles has been. And once we combine, we will definitely become a larger vehicle, and naturally there will be more weightage given to the enlarged REIT. And with that, visibility to this enlarged REIT will be there, and we'll be able to attract even more institutional investors, and that should help us in our future fundraising when we acquire assets later on. So we are both quite confident that we'll be able to deliver the long-term sustainable returns with a stabilized platform already.
So great strategy, great goodies,
Great sponsor.
great sponsor,
Yes.
An
great plan,
established platform.
holiday plan, everything is great. So with that, let me wrap up by asking you for your wishes for our audience, our unit holders. What will be your wish for them for the year of the water tiger?
Well, first thing is all shareholders to stay safe. I think, in my frank opinion, things are probably looking better. We hope so. We probably hit rock bottom the last 2 years, with COVID, with things. But sometimes a hard rock bottom is a good place. It's a solid foundation to recover.
You can only go up.
I wouldn't say it can go, but it's a solid foundation for us to do more. And I think for I believe for this merger exercise, we are able to do that. We have a solid foundation. 2 platforms coming, it's only strengthen the foundation, so such that we are able to acquire, we can grow more as well as faster pace. And hopefully, as you asked in the first question, there are many established REITs, and in no time, the ELOC will become also an established new economy REIT that is on par with some of the larger REITs that you see.
If not the largest.
If not the largest, yes. That's my wish for this year, and I think we have all the ingredients to do that. Line up, we need that platform, and I do hope unit holders of ESR-REIT will be able to support this proposition that we put forth to our unit holders.
Thank you for those well wishes, Adrian. And Karen, what are your wishes for the year of the tiger for our unit holders?
Other than hoping that everybody get a chance at the Toto that's coming up, that's the CNY Toto. We hope that will be that bright spot for our unit holders, and we have already explained the merits of this merger, and we have established our confidence that in delivering the long-term sustainable returns. So we believe that this merger will be beneficial to both sides of the unit holders, and we look forward to your support.
There's one last question. I'm not sure whether Adrian and Karen has a question on the probability, the scale of 1 to 10, 0 to 10, of getting approval. What are the odds?
Maybe I first. Yeah. I think we are still getting the proxies to coming in, because generally the proxies are coming in towards the late. And also one of the key item that we're looking out for is the proxy advisors advice. These are really independent guys. They advise all the big fund managers whether this deal is fair and reasonable, and after looking through all the details, and basically they do the work for the fund manager. So we're waiting for that proxy advice. But signals to us so far is that there are majority has a big support. They understand the rationale, and we asked 2 times. The first time around October when we first announced. We went back out again towards the end of the year, and also when we first announced. And I think the sentiments are similar. They understand that. We have a few large shareholders already telling us that they are supportive, but they just have to wait for the protocol, to wait for the proxy advisors' recommendation before they put in their votes. And I think the proxy advisors' votes recommendation should be coming soon, over the next few days or so. Yeah.
Okay, it's good to hear that.
Yep. Firstly, we are very confident in the merits of this proposed merger. So our unit holders are able to consider the merits that we have articulated very clearly in our decks and in this established dialogue so far. So, and most importantly is that one of our main shareholder, Ivanhoe Cambridge, has actually given us a irrevocable undertaking. And we have also engaged several of our institutional investors. They understand why we need to do this. And the size does matter stories and the potential upside that comes with it. And they are convinced that we will be able to deliver the returns and growing the REIT to get with our combined skill sets that both Adrian and I will bring to the enlarged platform. So we are quite confident that we will get this through.
Thank you, Karen, and thank you, Adrian. And with that, please, unit holders, join me in thanking Adrian, CEO of ESR-REIT, and Karen, CEO of ALOC, for their valuable time today in sharing the opportunities that we have with regards to the merger between the two organizations. And with that, we call the end to the SIAS ESR-REIT virtual dialogue this evening. Thank you for your time and have a good evening.
Thank you, everyone.
Thank you.
Thanks, Anchan.
Thank you.
Appreciate it.
Anchan.
Thank you.